Dear students, welcome to today's session. Today's topic for discussion is about the corporate governance committees. As I already said, there are different committees we need to study and discuss in the context of corporate governance, and it has been named after the individuals, and already we have discussed several provisions in the Cadbury's committee as well. So one by one we'll see. So in 1992, it has all started with the Cadbury committee. Its objective is to help raise the standards of corporate governance and the level of confidence in financial reporting and auditing by setting out clearly what it sees as the respective responsibility of those involved and what it believes is expected of them. So the committee was very clear in investigating the accountability of the board of directors to the shareholders and to the society as well. It submitted its report associated with that of Code of Best Practices in December 1992. So the Cadbury's Committee Best Practices has come out with 19 recommendations in the nature of guidelines with respect to the board of directors, non-executive directors, and then executive directors, and for several other officials as well. And these Code of Best Practices 19 were well received, while their recommendations themselves were not mandatory. The companies listed on London Stock Exchange were required to clearly state their statement of account, whether or not the code had been followed. So the Cadbury's Code of Best Practices had 19 recommendations. The recommendations are in the nature of guidelines related to whomever I said. So let me start with the recommendations given by the Cadbury's committee. The first is the board should meet regularly, retain full and effective control over the company, and monitor the executive management. That's the first one. Second, there should be a clearly accepted division of responsibilities at the head of a company, which will ensure balance of power and authority. So no individual has unfettered power of decision making. In companies where the chairman is also the chief executive, it is very much essential that there should be a strong and independent director on the board, who is a recognized senior member. The third, the board should include non-executive directors of sufficient caliber and number, so that they have significant weightage in board's decision. Then, the board should have a formal schedule of matters. Specifically, we reserving to it for decision, so we can ensure that the direction and control of the company is firmly in its hands. Then, there should be an agreed procedure for directors in the furtherance in the terms of duties to take independent professional advice if necessary at the company's expense. The last one, all directors should have access to the advice and services of the company secretary, who is responsible to the board for ensuring the board procedures and that applicable to the rules and regulations. So any question of the removal of company secretary should be a matter for the board as a whole. So these are all the recommendations pertaining to the Cadbury's committee. So with regard to the non-executive directors, the recommendations given by the Cadbury's committee is that the non-executive directors should bring an independent judgment to bear on issues of strategy, performance, resources, that may include some key appointments and standards of conduct as well. So the majority should be independent of the management and it should be free from any business or other relationship. We could materially interfere with the exercise of their independent management. So, non-executive directors, they should be appointed for specified terms and reappointment should not be automatic. Adding to that, non-executive directors should be selected through fair practices or formal process. That process and their appointment should be matter for the board as a whole. So these are all the recommendations given by the Cadbury's committee pertaining to the non-executive directors. For the executive directors, based on the Cadbury's Code of Best Practices, director's service contract should not exceed 3 years without shareholders' approval. Second, there should be full and disclosure of their total emoluments. Those of the chairman, that may include pension contributions, stock options. Separate figures should be given for salary and performance related elements and the basis on which the performance has to be measured. It has to be explained. Then executive directors, they have executive directors' pay should be subject to the recommendations of a remuneration committee made up wholly or mainly for the non-executive directors. So these are all the code of best practices given for the non-executive directors by the Cadbury's committee. See, one of the crucial role it is that stressed in the Cadbury's report. See, the need for it to observe it is for the code of best practices. It's one of self-regulation. The British companies, once they have felt that it's failed to comply with the voluntary code, so legislation and external regulations would follow. So how the corporate would react to the Cadbury's report? Actually, the report in fact shocked by many by its boldness, particularly by the code of best practices recommended by it. The most controversial and revolutionary requirement and the one that had the potential of significantly impacting the internal auditing. That was the requirement that the director should report on the effectiveness of the company system. So it was the extension of control beyond the financial matters that caused the controversy. The next committee is the Paul Ruthman Committee. It was constituted to deal with the already said controversial points in the Cadbury's report. So it watered down the proposals on the grounds of practicality. It restricted the reporting requirements to the internal financial control against the effectiveness of the company system of internal control. So the final report submitted by the committee, chaired by Ron Hampel, had some important and progressive elements, which has notably based on the extension of directors' responsibilities and all relevant control objectives that includes business risk assessment and how to minimize the risk of fraud. So these are all the points discussed under the Paul Ruthman Committee. The next committee which I want to discuss with you is that the Greenberry Committee. It was enacted in the year 1995. It was set up to identify the good practices by the Confederation of British Industry, which is known as CBI, in determining the director's remuneration to prepare the code of conduct, which can be used by the public limited companies of UK. So this committee's aim is to provide answers to the general concerns, can it be with accountability or the level of director's pay. And again, when you argue against the statutory control for strengthening accountability by the proper allocation of responsibility when you determine the director's remuneration, or the proper reporting to shareholders, or creating a greater transparency in the process. So it has produced the Greenberry's Code of Best Practice, where it has come out with 4 different sections. One is Remuneration Committee, second is Disclosures, third is Remuneration Policy, and the fourth is Service Contracts and Compensation. See, the Greenberry's committee recommended that the UK companies should implement the code as set out to the fullest extent practicable. They should make the annual complaint statements, and that the investor institution should use their power to ensure that the best practice is followed. So this is how the different committees were enacted, and of course their objectives matter. The next is the Hampel Committee, which was enacted in the year 1995. The objective of it is to promote high standards of corporate governance in terms of protecting investors and preserving and enhancing the standing of companies listed on the London Stock Exchange. So what is the role of this particular committee? They developed further the Cadbury report. Adding to that, they have recommended the auditors should report on internal control privately to the directors. The directors maintain and review all, not just financial, all controls. Companies that do not already have an internal audit function should from time to time review their need for one. So this is something like a combined code, consolidates the recommendations of the earlier governance reports. Can it be Cadbury and Greenberry? So with regard to the Hampel Committee, it is consolidation of both these committees. Then Trunbull Committee. Trunbull Committee was set up in the year 1999 by the Institute of Chartered Accountants in England and Wales. Its objective is to provide assistance to companies or providing guidance to assist the companies in implementing the requirements of the combined code, and that is also relevant to the internal control. So the committee provided guidance to assist companies in implementing the requirements of the combined code, recommended that where companies do not have an internal audit function, the board should consider the need for carrying out an internal audit annually. So corporate governance is a constantly evolving one to reflect the current corporate, economic and legal environment. To be effective, corporate governance practices need to be tailored to the particular needs, objectives and risk management structure of an organization. Corporate governance is not a static concept. In fact, it is dynamic, and that needs to be altered with the changes that occur in the business environment. So this is how it has taken several different forms. As we have already discussed about OECD principles, it was one of the earliest non-governmental organizations who have worked out and spelled out the principles and practices that should govern the corporate, and keeping it in mind the goal that to attain a long-term shareholder value. So it has a great universal, or even I can say that it has owned the universal acclaim, especially with regard to the authorities of corporate governance. OECD principles are like trendsetters as the codes of best practices, and that is again getting affiliated to the Cadbury's report. OECD, as we have discussed in the previous sessions, they have come out with several different provisions, right? I have already given an elaboration on this: the rights of shareholders, equitable treatment of shareholders, the role of stakeholders in corporate governance, disclosure and transparency, and the responsibilities of the board as well. So this is the way in which the corporate governance committees are working. McKinsey has given the International Management Organization, it has given an outcome based on a survey with regard to a sample size of 188 respondents, 188 companies. Okay. Now we are going to see about the McKinsey's survey on corporate governance. We all know that it is an internationally acclaimed management consultant organization. They have conducted a survey from 88 companies across 6 different markets, emerging markets like India, Malaysia, Mexico, South Korea, Taiwan and Turkey. So they just wanted to determine the correlation between good corporate governance and market valuation of the company. The results of the survey pointed out that there is a positive correlation between the two. So good governance obviously increases the market valuation. In what ways it increases? Increasing in financial performance, increasing in terms of transparency by reducing the risk that the boards will serve their own self-interest, increasing investor confidence. So McKinsey started to rate the performance of corporate governance of every company based on accountability, disclosure and transparency, and shareholder equality. So what it has found that the companies with good governance practices have a high price to book values that indicates that investors are willing to pay a premium for their shares of a well-managed and governed company. They also revealed that the investors are willing to pay us a premium of as much as 28% of share. If you are having a good governance structure, that actually attracts the investors to come further. Companies in the emerging markets often claim that Western corporate governance standards do not apply to them. The survey has said the 6 emerging markets has shown that the investors would overlook for higher standards of corporate governance. They are willing to pay high premium based on the requirements of the governance standard. Then the next act which I want to discuss is that the Sarbanes-Oxley Act 2002. See, it was enacted in this year, despite the fact that there have been differences between several other scandals. There is a common thread running. So the common thread in the governance matters. Good governance promotes good corporate decision making. So Sarbanes-Oxley Act is the step they have taken which codifies the standards of good governance. The Act calls for protection to those who have the courage to bring frauds to the attention of those who have to handle the frauds. So to ensure that such things that are not left to the individuals who may or may not choose to reveal them. It is better for the corporations to appoint an officer with the responsibility to oversee compliance and ethical issues. Unless CG is integrated with strategic planning and shareholders who are really willing to bear the additional expenses that may be required, effective corporate governance can't be achieved. Sarbanes-Oxley Act is a sincere attempt to address all such issues. I have discussed this in the previous lecture, no? When you talk about obligation to the employees, you should encourage the whistleblowing culture. Then only you can sort out an issue which will be in the long run create a big problem. So it's a sincere attempt by the Sarbanes-Oxley Act to address all the issues associated with corporate failures, to achieve quality governance and to restore investors' confidence. The Act was formulated to protect the investors by improving the accuracy and reliability of corporate disclosures. It made very precious to the securities laws. And this particular act comprises of number of provisions that dramatically change the reporting and governance obligations of public companies. One is with regard to audit committee, conflict of interest, audit, partner, rotation, prohibition of non-audit services, CEOs and CFOs, they have required to affirm financials, penalties, loans to directors. So these are all the provisions which we have created or that has been there in the SOX Act. So with regard to the establishment of the Public Company Accounting Oversight Board, so the SOX Act comes with the first provision of the establishment of Public Company Accounting Oversight Board. So it has to create a new board that should comprise of 5 members, of whom 2 will be certified public accountants, and all accounting firms have to register themselves with this board and they have to submit their details, other particulars or fees from the public company clients, can it be with audit or non-auditing services, and then all the financial information about the firm, list of firm staff who participate in the audit, quality control policies, information on civil, criminal and disciplinary proceedings against the firm. So this is how, these are all the information they have to give, have to register themselves and submit. So the board will conduct annual inspection of the firms, which audit more than 100 public companies and once in 3 years in other cases. So the board will establish rules governing the audit quality. The board reports to the authorities the standards the board required to send a report in an annual frequency, and the new board replaces the old one which was funded by the fees collected from the public companies. So according to SOX Act, we have to go with several other provisions as well, which would certainly enhance the accountability levels of directors, officers, auditors, security analysts and legal counsel involved in the financial markets. As far as we have seen, overall the global committees, their guidelines, and already in Indian model of corporate governance I have discussed how CII, SEBI have given their guidelines, and as far as the Companies Act has been concerned, how it was rooted and it has paved its way towards the Code of Corporate Governance in India. So this is how each and every initiative, every single committee's recommendations to ensure there is a great standard of good governance practices and principles. Okay, so with this I'll end this particular session. So kindly go through all the different committees' recommendations and make a note of it. Thank you for listening to today's session.